Eaton, ticker ETN, just gave investors a split result. Electrical Americas orders rose 41%, while total segment margin remained 80 basis points below last year. After earnings, the decision is simple. Is record demand becoming durable cash, or is the stock pricing conversion too early? My provisional answer is watch, not chase. Eaton has already proved the demand. The next quarter must prove the margin ramp. The market liked the report. Shares rose 7.3% after Eaton beat expectations and raised its full-year outlook. But a relief rally does not settle the investment case. It only tells us that expectations had become nervous. The report also does not make Eaton cheap or expensive by itself. No live valuation multiple is needed to answer this stage of the question. First, determine whether the operating engine is improving. Price matters after that. The real test begins with demand quality. If Eaton is genuinely benefiting from a durable power infrastructure cycle, growth should not depend only on one acquisition or one data center customer. Organic sales should accelerate. Orders should stay ahead of shipments, and backlog should grow across the electrical portfolio. That is largely what happened. Eaton's total sales increased 21% in the second quarter. 7 percentage points came from acquisitions, but organic growth was still 14%. Electrical Americas grew 18% organically. Electrical Global also grew 18% organically, even though Boyd Thermal added another 25 percentage points to that segment's reported growth. That distinction matters. The acquisition made the headline larger, but it did not create the underlying acceleration. The order data is even stronger. Electrical Americas orders increased 41% on a rolling 12-month basis. Electrical Global orders rose 33% organically. Across the electrical businesses, backlog increased 43%, while book-to-bill remained above 1. In plain English, new demand is still arriving faster than Eaton is shipping existing work. Data centers are a major driver, but they are not the entire story. Eaton said second quarter data center orders rose about 85%, while data center revenue rose about 65%. That gap adds visibility, but it also leaves more work to manufacture, deliver, and convert. Management also pointed to broad demand across utilities, commercial buildings, industrial facilities, and other end markets. So the first decision shift is clear. The concern is no longer whether the AI power cycle is real. Eaton's organic growth, order rate, and backlog all support that thesis. But backlog is a promise from the customer, not cash in the shareholder's pocket. That brings us to the harder question. If the conversion is working, margins should improve as new capacity ramps, and free cash flow should rise as higher revenue moves through the system. The evidence is positive, but not complete. Eaton reported a 23.1% segment margin. That was slightly above its own guidance and improved sequentially. Electrical Americas reached a 27.5% margin, up 190 basis points from the first quarter. That sequential improvement is important. It supports management's argument that capacity investments are beginning to produce operating leverage. However, the company-wide segment margin was still 80 basis points below the second quarter of last year. Electrical Americas margin was also lower year over year, despite its strong sales growth. This is the central contradiction. Eaton is selling more, taking more orders, and building more backlog, but the full margin benefit has not arrived yet. Cash flow gives the bull case more support. Free cash flow increased 22% to $874 million. Operating cash flow rose faster than capital spending, so the quarter did produce more real cash, not just more adjusted earnings. Still, 1 quarter of improving cash flow does not prove the entire backlog will convert at attractive returns. Eaton is integrating Boyd Thermal and other acquisitions while expanding capacity. Those moves can widen the opportunity, but they also make clean comparisons harder. The strongest bull case is that the margin pressure is temporary. Second quarter results exceeded Eaton's guidance. Electrical Americas margin improved sharply from the first quarter, and management raised full-year organic growth and adjusted earnings guidance. More importantly, Eaton now guides third quarter organic growth of 13.5 to 15.5% and segment margin of 24.6 to 25%. That would be a meaningful step above the second quarter. The bear case is simpler. If margins miss that range while orders remain elevated, then backlog may be converting with more cost, delay, or unfavorable mix than investors expect. If order growth or book-to-bill also weakens, the market may have paid too early for a peak demand narrative. That creates a practical three-part framework. The bull case requires Eaton to deliver the guided third quarter margin step-up while keeping electrical orders ahead of sales. It also needs to remain on track for full-year free cash flow between $3.9 and $4.3 billion. The base case is where the evidence sits today. Demand is strong, conversion is improving, but the year-over-year margin gap is not fully closed. That supports patience rather than assuming the backlog has already become earnings. The bear case begins if third quarter margin falls below guidance, electrical book-to-bill moves toward or below 1, or management reduces the cash flow outlook. Any one of those would weaken the idea that this is only temporary capacity ramp friction. So, what must happen next? Watch the third quarter segment margin first. It is the cleanest near-term test because management has already defined the range. Then check whether electrical order growth and book-to-bill remain healthy. Finally, confirm that full-year free cash flow is still on track. Verdict: Eaton proved the AI power demand, but it has not fully proved the margin conversion, so ETN remains a watch after earnings. The next test is third quarter segment margin inside 24.6 to 25%. Then compare Eaton with Quanta Services, where the same bottleneck is monetized through construction instead of equipment.